like then for note. So, Kerwin, just a test there. People online are hearing clearly. Okay, great. All right, so just going to throw out a few questions here. Um, I don't know if the people online would be able to so much answer it, but feel free, the audience here, to throw out some responses. My income always meets my expenses. All the time, most of the time, sometimes, or never. Okay, all right. In attempting to meet my expenses, I have savings left, just manage to meet expenses, owe family and friends, fail to meet expenses. Okay. Okay, all right. You'll see the range of answers that coming through. In attempting to make ends meet, I budget in order to make ends meet. I do not budget because I have enough income. My income is so small, there's nothing to budget. I only budget when I'm short of income. Right, okay. Right. So we get in a sense that there's people in different buckets, right? Because answering some of these questions in a particular way would suggest an extent, you know, your current financial health. Yeah. What arrangements do I have for meeting future expenses, such as education, vacation, and pension? By saving on a regular basis, by investing on a regular basis, by saving occasionally, by borrowing if and when necessary. Right. So something to consider as well about the future. So we get in a kind of framework in mind as to the kinds of challenges or situations that we all face over a lifetime. And you would find that different answers, the answers probably vary depending on the demographic and the age, right? So keep it in mind, keep track of your answers, and you'll get a sense from how you're answering these questions. When we go through the different aspects, you know, you will sense that there may be a gap that you may have, right? If terminated from your current employment, how long do you think you can manage financially before obtaining a new job? Approximately 1 year, approximately 6 months, approximately 3 months, less than 3 months. Yeah, right? Okay. And this would also speak to different elements of covering off risk and things that you're supposed to have in place in your financial plan, like emergency funds set aside in a particular way in order to deal with these types of situations, right? Which of these statements best describes your position on money and finance? I always make sure I have money saved for a rainy day. I tend to live for today and let tomorrow see for itself. I find it more satisfying to spend money than to save it for the long term. I find it difficult to plan and save for the future. Right. So now that we've set some of the groundwork and got our minds ticking over, I'm going to jump into the presentation and start to work through. When I'm finished with budgeting, I'm going to switch over to a video on debt management, and then we'll continue with the presentation. Unfortunately, at no point in time, you'll get a break from my voice because the voice in the video is also my voice, right? But so that's just the way it's going to have to go for the next couple hours. So probably, yeah, lights and just play for a few seconds and pause for me if somebody could on the laptop. Just yeah, play and then I'll tell you when to just was right here. Right. So assessing your financial situation. This is where we have to take a snapshot of certain key features of our financial plan. Okay, go again, Kanisha. So income, expenses, assets, and liabilities. Income and expenses, we're going to delve deeper into it, but when we looking at the budget, but right here, right? So income expenses, that would be your own personal profit and loss or your income statement. What I want to spend a little time on here is assets and liabilities. So assets and liabilities, we lay that out in what we call a personal financial statement or personal statement of affairs. This is critical because it lets us know it gives us a figure called our net worth. So assets are generally considered to be what we own, and liabilities are generally considered to be what we owe. But further to that, really and truly, the key differentiator that between assets and liabilities are really assets are things that bring money to us or put money in our pocket over time in the future, whereas liabilities are things that take money from us, or we have to, have cash flows to outward to deal with. So once we lay out our assets and our liabilities, assets and liabilities, the net figure is called net worth. So if assets take away liabilities is positive, then we have a positive net worth. And if it is a negative figure, then you have a negative net worth. And if you have a negative net worth, you have a situation to deal with. Right? It's not that the world immediately falls apart if you suddenly calculate this and it's negative, but it would suggest that you need to put a plan in place to move yourself from that position into a positive one. Just like even with a corporation, an entity, a company cannot persist forever with a negative net worth. It suggests financial problems. It would suggest that the investors may either not be attracted to the company or may want to pull out. You would have to pay more for your debt to borrow. Your borrowing costs will go up. So there are different things on a company level as well, and the same is on the personal level. So one other thing you want to pay attention to, you would have laid out on the two sides, assets and liabilities, but then you want to break out the assets into current assets and the liabilities into current liabilities. So the difference between the two is that current suggests that anything within the next 12 months that is payable would be considered current liabilities, and any assets that you have that are easily converted to cash or can be converted to cash within the next 12 months is considered current liabilities. And sorry, current assets, right? And then you would have the anything beyond that would be considered long-term. So what it would then help you to see is that you have enough current assets to meet the liability. There's a match in the timing, right? And if there's a significant mismatch, what you could find happening is sometimes you may have to liquidate something that's long-term in a hurried manner, and you take a lower price rate or a loss in order to get cash to fund current liabilities, right? So it's also important to do that breakout, understand the net worth aspect of it, and have a plan to move from negative, if it is negative, to positive. And of course, on the income and expenses side, if there's a deficit between income and expenses as versus a surplus, that would also suggest a need to do some adjustments in some form or fashion along the way in order to improve financial health. But we just move on a bit again. So I spoke about goals earlier, and well, main distinctions, right? The short-term goals, long-term goals, and medium-term goals. These also will be tied to uh, how we approach each bucket in terms of finances and in terms of not planning for it and for in terms of investments as well. So short term is generally considered anything between 1 to 2 or sometimes 3 years kind of thing, but 3 to 7 is generally considered medium term, and long term is over 7. So if you are in year 1 or this year, and you look at it, you may be planning for either university. Some people are planning to buy a house. So, depending long term, depending on your age, would be retirement, right? And short term, it would suggest that there are um, different buckets of investments that you would consider putting money in. And just one distinction, there is a difference between savings and investments, and sometimes it's used interchangeably, but that is not only a misnomer, but it's just wrong, right? It's misleading, right? Savings is really just setting aside money, normally in some type of bank account or in some cases under the mattress, right? Kind of thing. But it generally doesn't come along with the notion of risk. While investments are specific to setting aside money, yes, but for the purpose of additional returns while taking on some level of risk. So it's the idea of giving up the comfort of no risk for the reward of return. So that's really the distinction. And I would just also just to put it out there, I would challenge to say that even when monies are left in a bank account, even though you do have coverage from deposit insurance up to 125,000, and that really covers if the financial institution fails. Even though you have all of that, or even if you sleep on top of a safe, and then you put the mattress on top of that, it is still not as safe as we think, because it is exposed to one of the most stealthy taxes or risk, which is inflation risk, right? So you must always be aware that inflation is ever present. It's defined as a persistent general increase in prices. That's what the economists call it. But it's just an erosion of your money's value over time. And those of us who have been around long enough would remember when houses were one price, or even as simple as back in school, that pack of chili baby was 25 cents. And the same pack now is about $5, and they're not tasting as good, right? So inflation is all around, as I say, and if you don't do anything to offset inflation, then it will just continuously erode. And you kind of have to be aware as to different. I mean, you hear about inflation in the economy, different percentages are quoted. You have to be careful of that term, headline inflation, which is the overall inflation in the economy. But then there's core inflation, which is inflation in terms of food and certain items. And you really have to look at the things that you buy and look at to see what is really happening around to understand the extent of the inflation is having on your pocket. So we are establishing where we are right now, and then we set specific goals, and we tie those goals in with different types of investments, and we tie it in with our next point, which is our budget. So you could just go ahead. Right. So what is a
they do budget.
Yeah, yeah, just to the next screen. Yeah. What's this? I mean, bills first. Bills first, everything after. Okay, that's one way to go about it. Um, I'm going to challenge that just now, but fine. That's one way people do it. Anybody else? What is a budget, and what how if you do a budget, how you go about doing the budget? Okay, financial plan. So how you go about doing it if you do one? Not everybody does one, so just I mean, some people just don't do it. So right, yeah, yeah, yeah. No, these are real things. Yeah. Listen, none of this is so. When we leave here, I don't expect everybody to be happy. Um, I also may not leave as happy as I came in, right? But what I would say is something that we can't continue to be unaware of or ignore, right? And it's definitely something that if we are able to take it on board, I could tell you have a high percentage of seeing improvements, right? So any other ideas, budget? So, all right. So yeah, so some people do just that. They have their income, they have an idea what that is, they pay all the bills, and then they hope for the best after, right? So that's one approach. Some people do it the other way. They spend on what they want, and then, well, if they could pay Wasa or TNTech after, well, they pay that, right? So that's another approach, right? And some people just spend on the bills, and then there is nothing after, right? So you have various situations, but a budget is really, as Cohen was alluded to, is one key tool in planning, right? So this is I'm going to lay out to you the starting point of somehow people do it, but they don't take it further. So some people have a budget, and what they do is they lay out their income and expenses, and they do it when they get paid, and they do a plan as to how they're going to spend that money, and they put it down on paper, which is very important, right? And then they say, okay, this is what I spent, this that, and they have an idea as to what they did for the month. Okay, so that's just the bare basic starting point. In laying out, in conducting your budgeting exercise, as at the start of the year or the end of the previous year, you lay out income, expenditure, and you do 12 columns, and you project straight across for the next year. So a budget is really an annual preparation to start with. So you put January, February, March, straight down December on top. Those of you who into Excel would just do up your Excel spreadsheet. So that will be going across the columns, and then coming down would be your income. You take into consideration all elements of income. Some people have different sources. Some people have more than one job. Some people have side business and a job. Also, some people get overtime. So you try to project all of this in some form or fashion for the year. You also take into consideration any dividends or interest income that you may be getting from your investments. That also rolls back into income. Once you have all the elements of your income laid out, you then total that, and then you come down after that now, and you have expenses. And the expenses is everything you try to project and consider. So some would be easy to determine. There will be fixed elements from ranging from mortgage or rent or loan installments, that kind of thing. But there will be some that are a little more variable. You may have an idea what you spend on food, right? But You want to budget for birthdays, you want to budget for Christmas. If you're into carnival, you want to budget for carnival, and so on and so on. Then you want to have an element called contingencies. So contingencies just has to do with something that may happen. You may want to build in a 5% or something for that. And the other thing the budget helps us to see is our non non-frequent or non-monthly expenses, which if you don't have a budget, you tend to lose track of. So, and those payments tend to be pretty large or larger than what you do on some of your normal utilities. So house insurance, which would come up once for the year, car insurance, which will come up once or twice for the year, depending on the number of vehicles you have. And the timing is important, so you put it down in the month in which it will be occurring. School fees, those might be quarterly in some cases, per semester. And what that helps for you to have is an exact picture of surplus and deficit in particular months. On the income side, some people get bonus at certain times of the year, or a quarterly allowance that, it makes their income higher at that point. So what you want to be able to do from when you lay out this entire flow for the year, you will now be able to see the months that there's a deficit and months that there's a surplus, and plan accordingly. So it's not that you would naturally spend out the surplus in the surplus months and then be scrambling in the deficit months, right? So this is what the budget helps you to see, and it also now helps you to avoid another pitfall. And I'm just going to, even though we're going to talk about it, you're going to see it a bit in the video on debt management. It helps us avoid the pitfalls that come along with misuse or misunderstanding surrounding credit cards. So without the budget, people are sometimes or often surprised by the higher expenses that if they had the budget, they would have been able to see it. So in not seeing it, and then it surprises, now we have to fund it. How you're funding it might turn to the credit card. When you turn to the credit card now, people don't understand how credit card work. So a lot of people think, I have this credit card, the balance is 10,000, the limit is 10,000, and I'm going to put, as I normally spend 2,000 on it regular, but now I have this extra expense in the month, so I come up to 9,900. So 9,900 is on the credit card. And then the banks tell you very smoothly, you could pay this minimum payment. So you pay this minimum payment, and then everything rolls, and you're not in any trouble with anybody. You funded your thing, you're going along your merry way. Right. Now, credit cards attract 24% per annum in interest, which is pretty high compared to a regular loan, and probably is only surpassed by the money lender or island finance or somebody type of lending, right? So it's pretty high. What people also don't understand is that, let's say this $9,900 balance was there, and I pay off 9,800. I naturally would think that the interest that would then be running would be on the 100 that's outstanding. But no, it runs on the entire amount until you pay off everything. Right? So this is something else that people don't really understand in the use of the credit card, that yes, there are advantages if you could manage your credit card properly. And managing your credit card properly means I use my credit card, I take the points or the miles as I go along, and I pay off the credit card in its entirety at the due date that the payments for the credit card is due. So what credit cards afford is a maximum, I would say, 50-day period interest-free. So your cycle would probably start on the 20th or so of the month. If you put a transaction on the 21st or so, you technically will have the whole of well, the rest of that month, the whole of the next month, and 10 days into the following month until you have to pay it off. So normally 30 plus 10 plus the 10 before will give you 50. So that's if you put that payment on right there as the cycle starts. So that's what, I mean, as you put transactions on going on, it will still be due by the next thing, right? But so that's what credit cards afford. And of course, things happen, there are emergencies. Sometimes you are in a financial bind, and it's always good to have, some backup there to pay for things. But as I just was to reiterate, sometimes without the budget, without having that whole picture of everything, not having the timing of higher outflows, and it's not in your sight, may turn to the credit card and then misuse the credit card. But then generally, I mean, you may have been misusing it throughout the year anyway, right? Just as a higher misuse, right? So, and that's prevalent. And then the interest is adding. Some people don't really pay attention to the credit card statement as well. And then it keeps rolling, and then you're wondering why you're just paying this minimum payment and you can't come out of this thing at all, right? So this covers part of debt management because it is a form of debt, and it just also ties into budgeting. I could pause now. I think this is a good point to pause for questions. Any questions from online? Any questions from the audience here? Well, not better, it's different. It's like comparing LeBron and Jordan, right? But it's different things. So a debit card, you have to have your money there. Huh? Yeah, the debit card is a different instrument altogether. I think, it just gives safety of not having to carry around cash. There are international debit cards as well, so you can go to other countries and use that. Credit cards come in very useful because, especially now where the US cash is limited, so to getting cash, and you have to travel, right? The bank gonna watch you and give you probably 200 to travel with in terms of cash. But when you go to spend, you would have your credit card and your US limit. So, I mean, credit cards are useful. I'm not saying don't have one, just know how to manage it and know how to avoid, some of the pitfalls. Mm-hmm. Yeah. In most cases, your credit card is also accepted worldwide once the store carries a Visa sign or whatever, right? And the limit that you have on the card with respect to US usage would apply when you travel. No, not well. It depends on the type of credit card. So, like, in terms of, so like the Republic Bank credit card, there is a TT side and a US side. So you limit in TT and in US. And when you pay, right, it comes out on the US side, but you will settle in whatever the rate is on the day in Trinidad. And it tends to work out, that tends to work out a lot better than if it's settled in TT and converted by the international bank at that time to be settled on your card. Generally, yeah, generally, that's been my experience. Yeah. 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 And that is one of the ways to. Thanks very much. Yeah, that is one of the ways. Now, if you do have multiple credit cards, you would find that people abuse the multiple. And one of the ways to start rolling out of debt is to reduce the number of credit cards that you have. So some people have three. Say, I'll keep one and manage one, right? But there are advantages of having three as well if you can manage all three. Because again, if it is you, you say have a Scotia, a Royal, a Republic credit card, each one of them with a limit and a US usage. If you travel, then you have access to all three, right? So sometimes they, you know, as I say, but the key is being able to manage that. Or start over the response or okay. All right. So just to repeat, the question the question revolved around management of the credit card, and um, one of the members of the audience here was describing her experience with the credit card in terms of having it but not understanding it and ending up in the same situation of not being able to pay off the debt. And she did indeed give up the credit card. And I'm saying that that is one of the techniques that could be used in terms of debt management, because some people have multiple credit cards and are mismanaging multiple credit cards. And one of the first steps would be to reduce to come down to one credit card and learn to manage it properly, or to come out of credit cards altogether until you can manage it properly. But I was given the flip side that there may be advantages of having multiple credit cards in that, given each card would have its own US dollar limit, and you may want to travel, you would have access to the limits on all three cards in that event, right? But the key at the end of the day is the ability to manage it properly. You want to use the mic? Probably that might be best. So everybody.
Yes, so I get a credit card, I have a $10,000 limit. Um, I haven't used it. So with that, in that scenario, like for the month, I should be owing the bank nothing. Okay. And just before, what as we on cards, difference between a savings account and a checking account.
Right, yeah. So really and truly, if you don't use the card for the month, you wouldn't have anything outstanding for the bank, right? The only time that would happen with non-use and you'd still have something for the bank is if it's in the month where the annual fee for the credit card is due, because that will just pop up on the card and you will have that for the bank. So depending on the type of card you have, there would be the range of the annual fee. So on my credit card, I think I pay 60 US for the year. There are some more expensive, there are some cheaper. All right, and the question in terms of the difference between a savings and a checking, um, it's not significantly different. It may attract different fees in some cases, but checking accounts really come with checkbooks. I think, I mean, that's probably getting less and less popular. I think, you know, given that check used to be a major form of payment long time, but now you have so much internet transfer and, you know, different modes of payment. But I mean, I still keep one, use my checks from time to time. Just have to know, well, you have to have money to cover. You can't write bounce check as a penalty for that. Checks become stale dated, I think, after 6 months. Right? So if you write the check, somebody could hold that check for 6 months and then, you know, before it has to be reissued. But that's really the difference. You just pay attention to the fees, and because you would have to pay each time you get new checkbooks and that kind of thing. No. I wouldn't say that doesn't really come into play again now. Well, it might have some distinction, right? Because as I say, the check-in may come with, you know, that checkbook you may even pay something each time you write a check and those kinds of things, You might have some, depending on the bank, you'll have different fees that are attached to check-in as versus, but it's just a different form of the ability to pay by check is just a different convenience. But if that is not a feature of you doing any part of your life, well, probably no need to really have one. The whole idea of it, I'm just thinking is that, as I say, when checks were very popular, right? If you're writing checks, you would find a lot of, you would have to, pay out, do a lot of business via that. So your activity on it could be heavyish, but no longer. Yeah. Any questions anymore before we? Yeah. So, yeah. All right. So the question is, could you have a credit card as a safety net, and would there be a cost attached to it? Yes, you could have a credit card as a safety net. Yes, that is a good idea. It just means you have to manage it properly. And the cost attached to that I would just say, is the annual fee of having the credit card. Yeah. Okay. So anything from online? No? Anybody online? Okay. All right. That's just checking. That's okay. All right. All right. So I want to just switch over to just, excuse me, from the podium. What is debt? Debt can be classified as anything that is owed to you by some other party. At some point in our lives, we will all accumulate debt. The type of debt that we may have incurred, however, may vary. Debt can be categorized into three distinct types. Debt that is good, bad, and believe it or not, the best. Good debt, as the term implies, is debt that is used to acquire assets that are likely to pay income or increase in value over time. Generally, using debt to purchase property or fund education is classified. Debt can be classified as any debt. Debt can be classified as anything that is owed to you by some other party. At some point in our lives, we will all accumulate debt. The type of debt that we may have incurred, however, may vary. Debt can be categorized into three distinct types. Debt that is good, bad, and believe it or not, the best. Good debt, as the term implies, is debt that is used to acquire assets that are likely to pay income or increase in value over time. Generally, using debt to purchase property or fund education is classified as good because both of these expenses are actually investments. If the money you are spending is likely to generate returns in the medium to long term, then it is probably a wise investment and worth incurring that debt. Bad debt is any debt used to acquire short-term consumer goods such as clothing, entertainment, or electronics, for example. All these have a very short lifespan and usually depreciate rapidly in value when or if the decision is made to sell. Basically, once you put yourself into debt for things that you cannot afford and do not need, you are putting yourself into bad debt. Having elaborated somewhat on the first two types of debt, you may now be wondering about the last type. What is the best debt? The best debt, to put it quite simply, is having absolutely no debt at all, or reducing your debt burden as much as possible in order to live a virtually unfettered life. How do people fall into debt? Few of us today have cash readily available to purchase a house, a car, and appliances, just to name a few. We could become borrowers through bank and student loans, finance companies, and credit cards. Many of us, however, let debt get out of hand. Core reasons for persons falling into debt include using credit cards to meet living expenses. If you are putting purchases on credit cards just to make ends meet, or in other words, as extra income, then you could be in serious debt trouble.
Credit cards, after all, are a form of debt. Poor money management. A monthly spending plan is essential. It is very easy to spend more money than necessary and to rack up debt by spending impulsively without one. Living beyond your means. If you are living extravagantly and are not saving, then you are living beyond your financial means, which is a core cause of debt. Spending cash to come in hand. If you spend money in anticipation of receiving a lump sum, instead of it being of assistance, it can be a hindrance and can upset your financial situation. Financial illiteracy. One can find him or herself in debt simply by not being educated about finances. Without fully understanding how money works and grows, or the importance of saving and investing for a rainy day, undoubtedly debt would be incurred. I hope you found part 1 of our series on debt to be quite helpful. Stay tuned for part 2. We'll see you soon. Bye for now.
So I've heard people in the financial business say that how it's better to spend other people's money than your own, with respects to loans and stuff. Just want to know how that goes.
Just trying to Okay, so the question was along the lines of it's better to utilize other people's funding, and presuming you mean banks as versus. Yes, it's always better to. I mean, if somebody just lending you money or giving you money, it's better than using your own, I guess, in general. But if you're talking banking specifically, right? Um, okay, so that answer is it depends. So if you are taking on borrowing for the purpose of an investment, let's say, right? So what you're employing there, which could be part of an investment strategy, is leverage. So, for example, if I'm doing $1 million investment, I take the $1 million that I have and I fund the entire investment and I get back 10% on it, then I'll get $100,000 return, right? 10%. But if you were to fund that 80% from somebody else and you do 200,000 on your own, what you would find if the investment goes well and your cost of borrowing is, let's say, 3% or whatever, you would find that there's a magnified effect on the return on your equity from being able to do $1 million investment with only 200,000 of your money and 800,000 of borrowings of a certain cost. So you'll find that there's an amplified effect. So instead of technically earning 10% or whatever, you may find that when you calculate the return on investment, it's really closer to 18 or 20 or something like that, right? So that is what I think people allude to when they talk about that. The reverse is also true. If the investments go bad, it's an amplified negative effect. So that's why leverage or debt is a magnifier in terms of return on investment, right? Other than that, the other aspect to that is an inflationary one, in the sense that if I borrow today, and let's say the rate of inflation is kind of high at, let's say, 8 or 10%, and my cost of borrowing is probably 3% or 4%, then you may find that by accelerating and getting whatever you want today, based on the cost of the inflationary effects in the future, and also the fact that when you're paying back debt, you're paying back with money that is worth less than before because of inflation, then there could be an argument made for using borrowed money as versus your own money. Right, yeah. So if you just borrow money and save it, then you're putting yourself in a negative position, right? But that's why I use in an investment scenario. So again, it makes sense if it is you're able to borrow at 4% and you have an investment that giving you 8%. It makes sense to borrow to be able to achieve that type of investment and use of borrowings. Yeah. You earn a spread. That's what the banks do, eh? They operate on spreads, right? They borrow our money via deposits, but that's a liability on the bank's books. And they lend loans are assets at a higher rate. And then they declare a profit of 1.2 billion. Shout out to Republic. Yeah. Yeah. So any more questions? So any questions on debt? I mean, haven't seen the video on debt. Any questions on debt on the online squad, anybody? Okay, so one of the common questions, but clearly everybody in a good position, they don't have any set of debt. Because one of the common questions is, how do I get out of debt? No. Moving on. Yeah, so there are different schools of thought on getting out of debt, right? But and even just a basic consolidation might be helpful, right? Even a basic consolidation might be helpful because you may find that across different institutions, you may be paying different levels of interest. Even you have to examine the nature of your hire purchase agreements as well, right? Those could have some significant type of interest cost inside of there. And if you really look at it, look at the details, it may be better to get one loan at a particular rate termed out over a period of time than to have several forms of borrowing, right? Even on a credit card, if you think about it, if it is definitely better to take some kind of loan than to leave that limit on your credit card at 24%, right? So if you have a credit card balance of, let's say, 15,000 on your credit card and it's there, and you know you can't pay it off, better to access a loan and then term it out. But that's another type of mismatch that happens, right? Credit card is considered short-term funding. So you may take short-term funding to fund a long-term benefit or want or whatever it is in terms of, so you purchase a fridge or something that would last you for years, chances are if it would cost a certain amount. If you can't pay that off within within the short period of time, then you could end up in some issues there as well. And there are other methods, right? Snowball method, you could Google all of these things. Snowball method, avalanche method. It's just different approaches to tackling debt. So if you have various loans, you put yourself in a position where you focus energies on, some people say, pay off the largest installment first. And once you do that, and that is paid off, you use that larger payment. You don't move your standard of living. You use that larger, the money that you no longer put into what that larger payoff, in addition to the normal installment on the next loan, and you accelerate that, and then you accelerate until you clear off, right? So that's another method. Some suggest that you pay the highest interest rate loan first, right? So there's different approaches to it. You could research it for yourselves and choose one if it is you are in such a situation. So we pressing on, right? So risk protection. Just go back. Just go back. Right, so oh yeah, good. Right. So I'm going to spend a little time here because I think it's a under-discussed topic. I think there are a lot of myths floating around about notions about insurance. I think I understand where some of those notions may have come from. But this is also a key element of a financial plan, right? Or any sound financial plan. So I'm going to throw out a few questions first, just for you all to gauge, right, where you might be at in your position on it or your thinking. So have you sat down and identified your personal risk that you may be exposed to? Yes or no, if it's something you've done. Okay, so good question, even. Right, so personal risk is any type of risk that you're exposed to in life. Okay, so you have a risk that the car crashes, you're in an accident. You have a risk that you could get ill. You have a risk that your home may be damaged by something. Those types of things, personal risk. I mean, I don't think if a big stone just fall out of the sky, I guess that is some kind of risk as well, right? So those types of things, right? So that's the first thing. Is insurance one of the instruments you've identified to help you manage or minimize risk? Probably no. No. Yes, for some people. Okay. One of the instruments. Okay. If the answer is yes, what influenced you in choosing insurance to manage your risk? Is it that you understood the benefits? Is it that somebody advised you? Friends, family, agents approached you? Agents in most cases? Okay. Huh. Right. Right. Okay. Yeah. So yeah. So this is what I wanted to get to, right? Just what you said there, right? Which is that not many people understand it. Sometimes they're approached by an agent, and the agent may explain things, but they may explain things in a way, of course, trying to get toward a sale or whatever, right? And that in itself may have caused some issues or even caused apprehension, right, amongst people in terms of their understanding of the need for insurance, right? So insurance is key. If you look at life or the word life, there's an if in the middle. And you need to cover off that if as best as possible. Because insurance comes into play, especially for the ifs that you cannot manage for yourself. And I will tell you that I'm pretty sure, not having done the exact survey, that based on the understanding that I have in terms of what you should be looking at in terms of the amount of insurance coverage you have, I'm pretty sure that all of us here are underinsured. I'm sure the same is for a lot of people in Trinidad. Right? So, any questions up to this exact point?
Growing up, my dad would say, insurance people, all them just want is your money. Don't go in insurance. Because you find that you're in the insurance and you're paying, and you ain't getting back anything because nothing much ain't happening to you, so you don't have to pay for anything. So he always say them is smart, they're smart, and try to get your money. So we grew up with that, no insurance.
Yeah, what you're talking about there is a very real thing. And just to segue a bit, it also speaks to the generational conversations that happen, and sometimes the generational misleading that happens from one generation to the next, and it's something that we have to be very mindful of, because our very notions about money and ideas as to what is successful financial planning also come from our parents, right? And sometimes we have to, just like with a number of other things we do when we're growing up, we challenge our parents in terms of what they were thinking about, right? But it is something that we have to sit back and actually purposefully do in different areas. You know, was mommy really correct about this? And I mean, we're in an age where you could do all sorts of research, right? And your parents always, you know, in all cases, they will have tried to tell you as best as they knew, right? So it's not that they would have been purposefully trying to mislead you or anything, but there are times when, just like even with ourselves, right, as we move along in life, the best that we know, you know, even within our own lifespan, we recognize that, well, what I thought at 25 and what I think at 40, or what I understand better at 40, is something completely different, right? So it's the same thing, right? And yeah, we do have a lot of misnomers and misconceptions about money coming down through the generations, right? And not that Jonesy's belief wasn't rooted in anything in particular, because there is an element of truth to that, right? Because I think the insurance industry, just like the country, of course, would have been in a developmental mode. And while you're in this developmental mode, a lot of structures and regulations may not have been in place too, to deal with unscrupulous agents, right? So you would find a rapacious kind of element inside of different things, especially a man who working solely on commission, right? So it is there, but it does not necessarily mean that you know, these products don't really have a place in what it is, you know, in terms of proper financial planning, right? And I would say that, you know, insurance agents, from not all of them, but I would say especially some of the newer ones, and if they're very new to the industry, depend on their background, they cannot stand up to proper questioning. So it suggests then that the training is really on trying to close a sale rather than understand always the client's full situation. But if you deal with a mature agent who understands things, they have the proper conversations with you, right? So it's not everybody, right? And it doesn't mean that because they are bad actors that the products are unnecessary or not good products. Yeah. So some of the ifs or some of the things we want to cover. So one of the methods is called the dime method, right? In terms of determining how much insurance coverage you're supposed to have. That's fine, yeah. So you see it up there on the screen, right? Debt, income, mortgage, and education. So what this talks about is you should have enough insurance to cover your outstanding debts, to do some level of income replacement, to definitely cover the mortgage and education of children, if that is a major goal of yours. So I'm going to go through it, especially in terms of income replacement and education. So what it suggests is that either the main breadwinner or both parents really and truly, if they are working, so it depends on your particular situation, have to consider the idea that if either one of them dies, what is going to be the situation going forward for the family? So in the case of, say your children are, let's say you have a 12-year-old and a 16-year-old, right? You have to look at the situation as until these children are either 18 or if you want to really push it to 22, if you want to look at post-university stage, right? If one parent who is earning, let's say 10,000 dies, then that is a gap of 10,000 per month from age 12, because you have to go from the youngest child straight up to 22. So 10,000 by 12 is 120, by 10 is, right, you understand? So income replacement is a key calculation depending, of course it changes if you don't have dependents, right? And then it's your spouse alone. But you still have to look at that in terms of things. But of course there will be net offs. You may have a certain amount of savings. You may already have certain types of insurance in place, right? So you have to look at what are you may have an inheritance due, different things that could help net off what you may have to do coverage on. But generally speaking, if you don't have any net offs, you should have insurance to cover these types of risk. I will give an example. And in terms of mortgage, and you could roll it up also in terms of debt, right, overall. So I have a friend, he had 2 children with a young lady, and she was in the house, took the mortgage with TTMF. TTMF does not enforce, like a Republic Bank, that you have to have life insurance on this mortgage in order to get the mortgage. So if you go to Republic and a number of banks, in order to get the mortgage, you have to have house insurance and life insurance to cover the value of the mortgage. TTMF, no. So he did that, he didn't take out the insurance. He died under the age of 40. 2 young children, she in the house. Pressure. Because the mortgage was like 8,000 something. And she ain't working for 30 something thousand. And she had the 2 children. So that is the kind of situations, right? So you need to at least have your insurance in place to cover off these major debts in order not to leave your spouse and your children in a particular kind of situation, right? So I've seen it, I see what it looked like. It doesn't look good, right? But that's what it was, right? And education, again, if it's a goal of yours to take your children up to tertiary, especially in the situations where, you know, when you look at the course of tertiary education, it continues to kind of go up and up. And if that is something, I mean, there's a whole discussion about whether there's really value in tertiary level education for certain degrees. I mean, and that's another discussion, right? But you as the funder of all of these things, if you are no longer here to earn that income, then what happens? So this is one of the ways. I mean, there are more precise insurance calculators that you could go into that will take into count your exact situation and give you a result. But this is a good ballpark in terms of areas that could be covered off. Any questions on insurance? I'm almost sure there's something else I want to talk to, but any questions on insurance?
We have so much different companies. How do you start selecting one? How do you know surgical, the different types? Like, what is the best way to, what do you look out for? Because it's come with a fancy language, and how do you break down that?
Very good question. Okay, so you allude to a couple levels of analysis that you may have to go through. One would be the soundness of the company that you're selecting, right? So especially since CLICO, I would say that the insurance industry has been much more highly monitored and regulated. So that's one plus. In 2018, there's been additional legislation on the change in the Insurance Act and everything. So there's new legislation that also speaks to and governs the extent of detail and disclosure that agents supposed to give to people, right? So that as well is in play. I wouldn't want to call any specific names, but there are top insurance companies in the country, and short of probably delving into the financials of each one, but you could get a sense as to who is notably stable, and you could ask certain questions. Insurance companies have something called an AM Best rating, right? So there's a rating by an international or external agency that also suggests. So I mean, you could take a read of the some kind of report on the financials and check out the rating and see, at least to get an idea of the soundness of the company. So that's one. Two, shop around. So in terms of getting the most competitive type product, it may mean that you look at the risk that you want to cover off, and you engage different companies in terms of what they have under each one. Anything that you don't understand is something that it's incumbent on the agent to make as clear to you as possible, right? It's not just about you pitch me something and I don't understand, and you force me into a decision, right? So I would say that like take your time, ask the questions, get the details. I mean, sometimes I would say it might be best to get some kind of advisor along your side to understand it, because sometimes people don't know what questions to ask as well, right? So that could be a gap. So if you have an agent who isn't disclosing and you don't know what to ask, and that used to happen a lot with certain annuity products, where people didn't know what to ask, the agents didn't disclose, and then they were in the contract, and then it was only, of course, they give you the contract a few months later after it's approved by the BIR, and then people don't read the policy even then, right? So, you know, you're not aware as to certain things in terms of fees and how it works and that kind of thing. But again, I don't know if people are complying with the legislation, but the legislation speaks to the responsibility of the agent to disclose certain things now in a very clear way, right? But as I say, if you're not very confident about certain things, it might be good to have somebody who understands with finance a little better, or to get, in terms of dealing with agents, to get a referral to like an agent who you trust, or somebody you know trust that agent in a particular way, right? So that's another way, you know, not just dealing with a stranger, right? So that's another way to go after the right type of information. But it's important to get started. If it's not in place, it's important to try to have something in place. Another way to approach it too is so like recently, both with my uncle and with Ian, the conversation came up about car insurance, you know, and I told them, well, listen, I deal with Agostini brokers, and they get about 4 quotes for you one time, and you could actually save a lot on your car insurance by going through them. So, and this, I call the brokers, told them they would be, you know, I put them on to them, and they would have that conversation. So I'll see how that goes if they eventually save some money on the insurance. But, you know, they would, so that's car insurance, they, you know, would get, and it's faster than if you went to a set of different people, and they tend to probably get better rates because of that kind of group rate and all of that. Because my experience with that was 1 year, I saved about 1,600 on insurance premium, because when I got the quote straight from the company, it was 5,400 and something. And then when I went through Agostini, it was about 3,900, something like that, right? So I did it with well, I didn't actually do it with Agostini. I went back to my agent and I said, I'm getting it for this. I said, well, see what you could do. And he went back to the company and he got my policy under a similar group. But mind you, the agent was from the same company. That the agent was the 5,400 and the brokers was the 3,900, right? So it was the same quote from the same company, but he was able to go back and tell them so, and he was able to get that same group rate for me, so he matched it. So I gave him the business, right? But it's just to say that there's a lot of little nuances around that, you know, even with insurance and things that, you know, you have to, yeah, as many as possible.
Yeah.
All right, so term insurance is just for a particular period, and it is generally a lot cheaper than whole. So, in other words, you have, I guess it might be the difference between comprehensive and third party kind of thing, is in the sense of it's more basic, but you have something, and whole would be more expensive and more coverage. But I'm not like an expert in all the other nuances between them, but that's the basic, one of the basic differences. Yeah, any more questions on insurance? Because you have a big one coming up here, which is, I think retirement planning is the last one. Well, if you're already retired, there's no more planning on for the retirement. This is pre-retirement. here's another one, and this alludes to something else. Have you undertaken any of the following actions in the past 2 years in respect of insurance coverage? Increase the level of cover or benefits, modify the range of coverage, decrease the level of cover or benefits, made no change to the level of cover or benefits. So again, you need to also be revisiting not only your budget, which needs to be revisited during the course of the year as major things change, right? But also your situation in terms of insurance and the coverage and the range of coverage that you have, that kind of thing. So like personally, I had what I would say was probably a under coverage for critical illness up to 2 years ago. I met with my agent, we looked at it, and I did, and must kind of double it or something like that, right? Because also the insurance companies do new products, right? And they have better coverage sometimes, right? Wider coverage. So there's that. And then before the end of the year, I'm going to meet with him again to look at moving what might be my insurance coverage probably stops at 65 or 70, and they're now doing policies up to 80 or beyond or something. So that's another revision that, I will be meeting with him to look at. So as things progress, you need to try to look at different amending along the way. Children get older, different things, right? Health insurance, let me touch on that. Health insurance is also very important. If it's not offered through your employer, you could look into purchasing that privately. It is not overly expensive to get some kind of basic cover, but I would also advise anybody who doesn't have health insurance. But the thing about insurance, you don't buy insurance with money. You buy insurance with good health. So that's the other thing about insurance. If you're in good health, that's the time to buy. It mightn't seem that way, right? Because, people say, what are putting aside money for that for? So just, sometimes nothing gonna happen, but if something happens, the question is, do you have the means and the resources to help deal with it, right? It's right. Okay. So there's two different type of insurance. So the question was around insurance companies may approach with different types of policies. And in this example, the policies you're saying seem to be pretty limited in terms of if you are diagnosed with a particular, only 5 types of illness, then you could get a payout. So you said it seemed to be kind of limiting. So there's two. So health insurance is different from the insurance that you're talking about here. So there's health, which basically is if you have a current illness, and it could coincide with the type of insurance that you're talking about there, which is critical illness, which is also sometimes tied into disability, right? So there are different types of coverage, but health insurance is basically if you have to go to the doctor, you have to get some kind of medical treatment, or even if you have to be hospitalized, the insurance will absorb part of that cost. So sometimes up to 80 or 90% on drugs and medication, very little on the actual visit, and then a certain amount, probably 50, 60, 70% on the actual room and board, and if you have to stay in a private hospital, that kind of thing. So that's health. Critical illness is if you're diagnosed with what is considered critical illnesses. The list is really probably about 15 or probably a little more, but the main ones would be heart, stroke, cancer, diabetes. No, not diabetes. Diabetes is not considered critical, but yeah, those would be the main one. But there are some sub diagnoses, right? That are considered critical. Right? So critical illness, you could also have an element of income replacement if you're diagnosed with a critical illness, where you get a certain percentage of whatever your current income is, still coming to you. So there are different types of insurance that go along with that. Disability is if you're in an accident or you're actually disabled for some reason and you can't work. That's another type of coverage. Right? So there are different arm states, but all very important, I would say. Right? And these things are generally bundled. So you might have a life policy that bundles with critical and disability, or accidental death too is another type. Right? So you have different aspects of the insurance. Yeah, we good? All right. I'm going to touch on this other one quickly so we could get into the retirement planning. So when we considering what type of investment might be appropriate, there are some factors that we have to take into consideration. What type of return we might be looking for, the level of risk that we want to take. And when I say the level of risk or somebody's risk tolerance, we're talking about the ability to take risk and the willingness to take risk. So if somebody has, and this ties into the time horizon in terms of how the length of time that you have to set aside for investment, or tied with your type of goal. So if you have a long-term goal, then you have a long-term horizon. Or if you're a certain age, then you will have a long or short-term horizon in terms of investments. And risk now, the ability to take risk, ties into that. So if, generally speaking, if you're younger, you're considered to have a higher ability to take risk because you have the time to recover from losses. And if it is you have a large financial base already to absorb shocks, then you have an increased ability to take risk. And willingness to take risk is really your kind of psychological makeup. Because some people are able to take risks, but they're just not willing to lose any money, right? So there's that aspect of it, ability and willingness, and that balances off in terms of risk tolerance. Liquidity requirements is just in the sense of how much money do I need from, or when do I need money from these investments? So whether I need to access it or the type of returns, can I wait 10 years to get returns? That would be, if you can't, and that means your liquidity requirements are more immediate, then you wouldn't put your money in something that's going to take 10 years to mature and you get back your money, right? So it's those types of considerations in terms of liquidity requirements. And unique circumstances is just so you may have a personal disposition towards certain things. One example, you may have an aversion to smoking. You feel very strongly about smoking and its links to ill health for children, everything. You may say, here's what you're going to tell the investment manager, don't put my money in Whitco because I feel so strongly about that. a family member who got killed by drunk driving. I don't want anything to do with alcohol. I'm not supporting that. I'm not investing in Angostura, right? So those are things that are unique to you that you may believe, don't line up with your own things. You may even go to the point of you don't believe in animal testing. So you don't want to invest in any pharmaceutical companies or anything that test on animals. That's another example. It may be on religion too. If you're Muslim, depending on the extent of or your interpretations, right? You wouldn't invest in instruments that give interest. So that's another thing within Islamic law, and therefore you would stay clear of certain types of investments, right? So all of that goes into deciding on investments. Let's just jump into and close with retirement. Any questions here? Okay. It's just investments on a whole. Now going into the whole thing about retirement planning. Yeah. Right. Okay.
I know, just for the audience, seeing that, we in the information age and we have bombarded by, um, let's say, the online investing and the cryptocurrency and stuff. What is your thoughts on that?
Okay, so crypto in particular. Right, okay, so, and one of the, I'll say, so Ethereum might be popular, but Bitcoin is really the question, I guess you're asking, right? And my view is that cryptocurrency forms part of somebody's portfolio if they have the risk appetite for it. So when you look at investments, it's from a portfolio perspective. It's not, you don't put all your money in one thing. You consider the interactions between different types of investments with each other. So in order to get what you call a inverse correlation or a diversification effect, which is that if one asset is going up, you want to have that to be able to offset any asset that's going down to kind of smooth your returns that is not overly volatile, kind of thing, right? So you have a mix of assets. And so the whole notion that I'm going to put all your money into Bitcoin is a risky play. So I wouldn't say that might be the way to go depending on your situation. And the other thing about it is that people often do not have that perspective, and people bring the notion of Bitcoin to them, and then they say, yeah, put your money in this the other thing, the trending upward thing. Okay, fine, that might be so, but the same way trending upward, it could also switch to trending downward. And therefore, is it now a wise decision to take your sole 10,000, convert it to whatever US you could, and put all in Bitcoin, and then you can't eat or do something else, right? So to kind of bring it back into line, because Bitcoin's value is not one in and of itself. Like, so this has value because this water bottle might have value because the plastic might have some worth, but because I could use it to hold water that might have value to give to somebody else to sustain and do, or then I could take it and water this plant, something else might have value in it. but Bitcoin's value is generally based on the next person valuing it more than you, right? So you have to have a market for it and people buying it because they see it as more valuable and to pay more. So it could definitely be part of our portfolio, but I don't think it would be the majority or all of it, especially the average person who might be lured into it portfolio, right? Because there is an element of risk to it, and you have to be willing to take that risk and able to take that risk. And of course, yes, it could line up with part of your portfolio. Yeah. Sorry? No, I wouldn't put it that way. What you could say is that somebody who has a larger financial base could probably take on more risk, and therefore they could put more money into that. But the average person who may not have as much means, what it would suggest is you would have to temper how much you dabble in it. That's what I would say. Forex, okay, so, yeah. So the question is, what about Forex? Right. So Forex is similar in a way in the sense that people who play the currency markets are playing for a very short-term speculative need in like intraday losses and gains, right? So again, it is possible to make money in Forex, to lose money in Forex. Nothing is wrong with learning that skill and playing the currency markets to some extent. So just be prepared in the same way that there could be significant gains and significant losses all within the same day. Yeah? You experience it yourself? The gains and the losses? And the words. Huh? Okay, right. So some good losses and some gains. So you see it shoot up and then it just plummet and you probably won't be able to recoup same day. But it could be very addictive and exciting. And that's the part of it that I think, yes, could it's almost like kind of gambling vibes, right? So yeah. So again, understanding all the nuances of what you're getting into is important, right? I wouldn't tell somebody just, well, no, you can't do it, right? That's not my place, right? But I would tell somebody, understand this, understand what you're getting into, understand who is bringing it to you, ask these questions, do this before you get into it, and thing. And the other, well, as I say, I mean, if you have, it's not for some people, right? But I wouldn't, again, depend on who I'm talking to. If I know the person and whatever, I know they don't have that kind of discipline, they don't have that kind of money to lose, I'll say, brother, that ain't for you, right? But if I don't know the person, I would tell them, well, consider this, consider this, consider this thing. And people don't really want to listen a lot of times, So you can only lay the parameters out. I have kind of learned to just say what I have to say and then just divorce myself from it after, right? Because people have their own strong beliefs, and sometimes that's what you need to get away in life. You have to have strong beliefs, fine. But I remember all back in the day when I was with RBTT at the time, and Hindu Credit Union was all the rage, and you was trying to tell people, well, look at this. And like, oh no, they're robbing we, and this and that, and they, right? It was real back in the thing, and people didn't want to listen. Look at the kind of returns again, we, and you just take a while. It was real pressure as a banker, right? And then, of course, when everything hit the fan, why didn't tell me? Why didn't tell me? You say, yeah, we told you, you didn't want to listen, right? So there's that. There's all these Ponzi schemes masquerading as different things. right? That you tell people, watch out for this, that, and they don't take it on. They say, you trying to cramp the style and this and that, right? I remember last year in November, a little before that, there was Get GXL, right? That was circulating. It was circulating on the neighborhood chat in 500. It was circulating all over. A partner called me and he said, "Hey, what? Hey, look, I sent in here this." And he sent it to me. I said, "I just watch it." By the time I watch it, I just say, "Anyway, let me take a half hour and research it." And I pull up the thing online. The Get GXL sign is some road in Pinal on the front of looking like a container in the front of a building. Say, okay. I go on and I start to research it. I just humored myself to see what it was really about. But by the time he sent it, I knew it was some kind of scheme. I told him, I said, what woman sent this to you? He said, oh, it's a woman. I said, the fact that you sent it to me and you feel you was convinced enough to send it to me, I know it's some girl sent it to you. So he said, yeah, some lady sent it to him and she said, I said, boss, this is a scam. Right? Don't even bother to think. I said, mark my words, it's going to unfold up at some point. What I didn't know is that it was going to unfold up in the next week and a half, right? Which it did, right? But that you have to be aware of that. And what I could say is they all tend to have similar characteristics. And if you go back in history, right? If you go back in history and review the different types of Ponzi schemes, straight from Charles Ponzi scheme, straight down to the tulips fiasco in the Netherlands and in England, where tulips was a big time investment. Not necessarily a Ponzi scheme, but it have similar characteristics of a herd mentality and people rushing it. And then when it crashes, you can't find any of the original people who sold it to you and this kind of thing. You come down through all the financial scandals as well as the Ponzi schemes, you will see a lot of similar markers along the way. And if you're aware of it, from the time you see the next one pop up, your alarm bells will go off and you would at least take a concerted look at it before you jump into it. May not be a Ponzi scheme, but I'm just saying you wouldn't automatically rush to it, and that kind of thing. So that wasn't one of the areas I intended to cover, but that is also there. Real in the environment. Question online? In investors or investments? All right. Okay. I'll take it exactly as it is asked. Okay. So the question online is, what is the difference between conservative and risky investors? Right. So a conservative investor, it speaks to what I was talking about there before, your risk tolerance. So your ability and willingness to take risk. So if you have a low willingness to take risk, you would be considered a conservative investor. Whether or not you should be conservative is another story, in the sense that let's say you do have a long time horizon, you do have a large financial base, probably low liquidity requirements at the point in time, as well as the other needs are covered very easily. So you don't have to rely on the investments to fund you at that point in time. So your ability to take risk might be high, and you have a low willingness to take risk. If the discussions or by education and dialogue, you cannot move that person from understanding that, listen, despite the fact that you are scared to take risk, you should take risk. in the event that you cannot align the two, that person will ultimately remain a conservative investor. Right? But there would be a divergence between what they are and what they should be. And the flip side is just that the person is aggressive in terms of taking risk. Their mentality is of a risk-taking nature. So some people are like that. They'll say, hey, give me all the Bitcoin you have. Right? Give me all that currency risk. I don't care. If I lose all my money. So, and you don't necessarily have to ask them about money. You ask them about different things and things. So what it is you do last year, boss, I went bungee jumping off of so. And the year before, I can't wait to go that skydiving next year. That is a risk-taking person. Right? So just from how they approach life, you might see, hey, the more aggressive in terms of risk, and that may also reflect in the financial views. So you'll question them on that, but chances are it might line up. And then you will, once you recognize that they're willing to take risk, they're aggressive in terms of risk, you now see, can they take the risk? So the reverse could be true. Somebody could have a low ability to take risk and be aggressive, and that person, you have to advise them, listen, you really shouldn't be thinking and try to temper them in terms of their approaches to investment. So that would be the difference between conservative and risk-taking. And in terms of types of investments, you will see it, right? A conservative investor would go for something that is very stable. Chances of losing money is small or none, and a risky person you would see they say the whole portfolio in stocks, probably not even a well-diversified portfolio of stocks. It might be just 5 or 6 picks, which they feel going to do well, and they're very aggressive in that way. So stocks could be considered risky. Real estate is also considered risky in a way. Private equity, venture capital, there are different elements of investments that are risky. Forex, crypto, right? You would see them tending toward the portfolio having a big skew in that area.
So you describe the two types of investors. So if you're in Trinidad and you have, let's say you're kind of okay and you have some money to invest, forgetting the other requirements with your life, you're okay, but you have this money to invest. Could you give us two areas in terms of one conservative type of investment in Trinidad and one on the more risky end that you, as you survey the market?
Yeah, so conservative in Trinidad would be low risk mutual fund, what you call fixed NAV or fixed price mutual funds. There are several of them across the industry. So Republic has the money market fund. UTC has their second scheme. FCB has the Abercrombie. Home Mortgage Bank has the Mortgage Participation Fund. And Guardian has the TT Dollar Fixed Income Fund. So there are several across the industry that are fixed price mutual funds that would be considered low risk and conservative investments. Right? Across the aggressive side or the risky side, you could start to trend toward stocks. Real estate is also technically risky, right? From the point of view of you could invest in real estate and your income could be up and down from it, volatile. Certain things could go because your occupancy may not be high. You may have default on your payments from renters. You may have different issues, right? So real estate could be considered a riskier type of investment because of the volatility of the income that could come from it. Of course, even locally, you do have access to international markets. So stocks abroad and different types of stocks, you have different levels. You have emerging market stocks, right, which really from countries that are at a certain stage of development that are considered riskier, that would offer high returns if they pay off, but they could have volatility. And even bonds, right, which are technically kind of borrowings, like you're lending money to institutes, like a lending contract, right? So you're giving money to get back interest and repayments. You have different types of bonds out there, right? So conservative as well, it will be government bonds in Trinidad that will be considered conservative, right? But on the riskier side, you could have an unsecured corporate debt issued that might be considered a little more risky, but then you could go to what are called junk bonds, which is like on the international level. Those are like, there's a more than 30%, you might have a 30% chance of default, but you're willing to take that risk because the interest is double digit, right? So there's a lot out there in the universe of investments thing, but locally our market is kind of constrained. So I would just say, the mutual funds that are described on the lower end, and then you could have, certain concentrations in stocks or real estate, depending on the type of businesses or projects you take on, could be a little more risky. Yeah. Retirement planning? Oh, yeah. All right, okay. This one is a lot, but okay, so let me ask it this way. Let me just put in the essence of time, I'll just say it. So company pensions, NIS, are two main elements of funding retirement in Trinidad, right? I don't think people understand either very well. And on top of that, people don't start to plan for retirement early enough. So what we have as a result is a few years ago, Central Bank would have done a survey, and the survey would have said more than 50% of retirees are unable to maintain their standard of living in retirement. Right? So that's not a good statistic. We're going to roll it back and deal with some of the elements of funding retirement, but just understand that starting earlier is always better come forward. Company pension plans operate in different ways. As I say, not many people look at it, not many people understand it. There are two main types of pension plan. One is called a DB, or Defined Benefit Pension Plan. One is called a DC pension plan, or Defined Contribution Pension Plan. They operate in different ways. They carry different risks. And as I say, you need to understand what your arrangement is. And if you're looking to switch employers as well, what you need to consider sometimes in terms of what is actually a better offer or not. So a defined benefit pension plan just says you work X number of years, it's multiplied by a percentage, 1 point something percent or 2%, and you multiply that by your final salary or your highest salary, and that will determine what the pension will be. So the longer you work for the company, the higher your salary is, the more the pension would be. Some defined benefit pension plans, employers do contribute along with the employee, or in some cases, only the employer contributes. So there's that element as well. But what you would notice is that there is a set formula, and the company undertakes to fund the pension plan to the extent necessary in order to make sure that that set formula is met and that you get that pension over your pension over years. The DC pension plan says employer contributes X%, employee contributes X%. Normally, there might be a match or the employer would put more. And however those investments do over the period of time will then determine later on what your pension would be. So the risk in that case is on the employee in terms of, remember, you're just doing a contribution. However, the investments could go up or down, right? Your pension will be determined by that, right? And I would say that DC plans are becoming more, DB plans are considered expensive for companies, and they've been phasing it out and moving toward DC plans, right? So they've been transferring the risk from the employer to the employee. So that's a common trend in the country, right? Or in the world, right, generally. So just bear that in mind. Pension plans have what you call a vesting period, which is normally 5 years. So you have to have been with the employer for 5 years before you have a pension due to you. So from day one, when you are permanent, right, it's not normally due to contract people or temporary employees. So from the time you're permanent, the benefits start to accrue or be owed. But if you leave before 5 years, that falls away. You have nothing to get unless, like in the DC case, you had contributed, you get a refund of your contributions and that tax is taken out, right? But so that's how that vesting period works. And again, it's something people have to be, it's something to be aware of. And normally, pension plans, unless you are Dr. Rowley or a member of government or president or whatever, where you get your full salary as pension, for the general public, the most you could work up to is 2/3 of your final salary. So that's the maximum pension you could get from a company pension in the case of a DB plan. And normally you have to work in excess of between 33 and 38 years with the company to get up to the 2/3 amount. All right, so that's something to also be aware of under pension arrangements. NIS. So NIS kicks in at this point in time, roughly at 60. You have to have made 750 contributions to NIS in order to get those payments. In the event that you've made less than the 750, they do what you call a grant, and they calculate your contributions and pay out 3 times your contributions in a one-off payment. Right? So that's kind of how NIS starts to work for you, and it depends on the range, how much you were working for during the years, you would have contributed accordingly. So the top category, I think you have to be working for 13,000 and above, you will be in that top category. If you contribute more than the 750, then you get more than, you start to get more, your NIS payment will go up, right? NIS is not taxed, right? Whereas your company pension, along with any income you have from annuities that you would be getting back, once you cross the personal allowance, that will be taxed, right? But NIS is not taxed, right? So, and the other thing about NIS, I mean, we've been hearing the conversations about the retirement age, right? Something we have to be aware of. So the retirement age in the government service is 60, but the law at this point is that it is already at 65, right? So what I think they're trying to do is to move the actual payments to closer to 65, right? So that is coming. There's no stopping it. I don't think there's any stopping it. But we have to understand that what has brought us here to this point could be something that um, continues to deteriorate, right? And it is just for us to be very wary and have it in the back of our minds in terms of planning, because NIS is really under a lot of pressure. The portfolios have been under a lot of pressure for various reasons. One is Trinidad has an aging population. So as time goes on, the amount of people who are dependent on the system is starting to grow compared to the proportion that is contributing to the system. So that's one area of pressure on the funds. Another area would be poor performance of investments over at different points in time. Another area would be legislative constraints where NIB wasn't, it can't really invest. So we had issues locally in terms of availability of investments, but the legislation doesn't allow for NIB to invest outside of Trinidad in a more, I mean, beyond 20% of, you know, of the portfolio. So 80% has to be, you know, nearly the vast majority has to be in Trinidad, right? So you have, there's a lot of things constraining along the way that would be putting pressure on the funds. Then people are living longer, so that when, you know, some of these funds were contemplated, they were thinking, you know, that people are going to be dead by 65, right, or 70. But now you have people living to 80, 90, you know, thing, and there's more payments coming out of the system and that kind of thing. So it's different things they're attempting to balance off by, you know, moving the retirement age. Yeah, good. I can't say specifically because there is no upper ceiling on the, so there's no, so whereas I think the minimum is 3,000, right? They try to pay everybody 3,000. So in other words, some people are actually subsidized in a way because they may not have, depend on the class of income and the level of contributions, they may not really be due 3,000, but they get 3,000, right? And on the flip side, if you do more than the 750, you start to increase. But to say, I wouldn't be able to say there's an NIB specific calculation as to whether you land at 3,500 or more or whatever, right? Because there's no ceiling, right? But I don't have the data to say what's the most somebody getting now. Might be, I know, might be 36. I don't know what somebody getting. That would be the most. Yeah, yeah, Yvette. Mm. Yeah. Okay. Well, I'm not aware of you know how like that distinction, but I mean, something that, you know, might be worth some more investigation so that people are clear. Yeah, but my understanding is that they do have to take into consideration all your contributions, and 750 would be generally the minimum to get payments. And of course, there is no ceiling. So I guess if you did 2,000 contributions for some reason, then they would have, you know, that will continue, whatever. I don't know what that will allow you to reach. Yeah. I don't get the impression that you could do what they call additional voluntary contributions, like just generally, like how you and I working, and you just say you want to contribute more. I don't think so, but I think there's a situation where, let's say you stop working and you're under 60 for some reason, and you want to top up your contributions. I think there's some kind of allowance for that. Yeah. Okay. Well, yeah, well, um, well, I mean, I've been in dialogue with people from NIB. They never explained that to me, so I would take it back to them and see if I could get some clarification on that. But that's a good to know. But probably what would be instructive is to find out, like, realistically, how much contributions you have to make to really get up to that. So probably, well, I don't know, but probably you could reach it, but it might be. Start working at 10. I don't know. I don't know what it would take to reach it. Probably if you're in the highest range, straight from inception, and you start from, let's say, 18 or whatever, and you come straight through, you're probably in the max scenario, probably that's probably it. Yeah. That's good to know. And that might be a bit of a complex. Some pension plans are what you call harmonized with NIS. But that's a side explanation. That's not so necessary. Not all plans are like that. So what you want to remember here is that taxes, as I say, apply on if you have an annuity and that annuity is in the payout phase, and you add that to your company pension and any other income that you may be getting other than NIS, then once you cross your personal allowance, then taxes apply, just like when you were working. Right? So it's not that you become a pensioner and then you don't pay tax at all, depending on your income. Right? So there's that inside of there. And just to close off, to talk about annuities, right? Yeah. Right. Okay. So the observation is that the way of the work world now is a lot of contract employment, and contract employment doesn't attract company pension, and that is something that young people in the workforce need to be cognizant of. Very true. The employment landscape, the capitalist world on a whole is becoming harder, more advantageous in a lot of ways, and not to the benefit of employees. All right. So as things progress, you would find that a number of agreements are not going to favor the employee. You could go back and look at the demise of, especially with the continued demise of unions. So you saw, if you go back in the days, you saw Reagan and Thatcher, and they tried to break the unions, and they were successful in a lot of ways. And in America, it's a completely different landscape in terms of what can and cannot happen. I mean, an employee, you could go to work today and an employer could tell you, well, now here, what is it? You go home, right? So that's the nature of employment in private America, right? It's a little different here. But we see the trend here, right? I would say is a similar trend with the closure of Petrotrin, you would have found that one of the main benefits for the government would have been helping to break the union, right? So as unions continue to decline and companies are forced to be more and more competitive, and shareholders become more and more demanding, right? You're going to have that kind of trending. So to get specifically to what Kanisha is talking about there, an employer who keeps some issues contracts. Now, contracts tend to come with gratuity. So gratuity is some percentage, some cases 15, some cases 20% of the earnings or the basic salary earnings of the entire contract, right? So that is, in a sense, meant to cover off, or for you, the contract employee, to set aside to do your own pension arrangements, right? So that's what that is really meant to do. But people normally take it and say, well, there's free money to do something else, right? But that's what it's supposed to be. But yeah, you're correct. You have to be very aware of, you know, the difference between permanent and contract and what comes along with it, and that kind of thing. And as such now, leading into annuities, annuities are one vehicle that you could look at to help provide for retirement. But you have to ask the right questions, you have to do the right shopping around, you do have to ask about what are the relevant fees associated with the particular annuity arrangement, and be very clear on the response, right? Because one trend in the industry, especially when it was offered by a lot of the agents prior, and I think that's where some of the ideas behind insurance agents came about, was the whole notion that, well, you told me one thing and then it turned out to be something else. I put 10,000 in per year, is now year 5, I'm looking for, supposed to have 50-something thousand, because you tell me I was going to get 8% interest. And when I look now, I see my money saying 26,950. So what happened to my money, right? And that was common. Now, the agent was at fault because a lot of them didn't disclose how the commissions would have been coming directly from their contributions. And the individuals were at fault in the sense of, well, one, they didn't ask the right questions, but more so, when they eventually got their contract, they never read it, because it's not on page 1, somewhere in the middle, right? So most trainees might have glimpsed the first page, and like how they read newspaper, they read the first page, they read the back page, and then they close the rest of it, right? So you have a lack of thing there. And then the other problem that happened is the language in which it was written in the contract wasn't well understood, right? So instead of saying 30% fees would be deducted per year from your contributions, it would read something like 70% of the monies would be credited to the fund, and so, right? So then you're like, okay, well, no, somebody might stop and say, well, where the 30%, what are you talking about here, right? So that's another aspect here. So because of all of that, right, some of these annuities got a bad name. It wasn't so bad back in the 80s into the 90s, even though they weren't telling you these things. The interest rate environment was double digit. So you found that there was an ability to recoup in a certain way. So it wasn't as noticeable. But when we headed into probably after 2005 or somewhere there, right? When interest rates were no longer, probably after 2003, right? No longer as double digit. You found now when you start to get single digit, and when in fact it went below 5, you found that it was, well, the interest in not covering back anything. So it started to become very noticeable, and you're like, well, what's going on here, right? But you have to have a role in putting together some, or putting aside money for yourself in some sort of vehicle in order to supplement your retirement needs, right? And the earlier you start with that, the better. Understand, well, with a lot of these annuities, you get a tax break for your contributions, so it helps with a tax savings. But again, when the annuity matures and it's being paid out, once your income crosses the personal income tax threshold, then you have tax to pay at that point in time. I wouldn't bore you with how annuities actually work overall at the end, but just to say that the annuity payment will be determined based on the interest rate environment at that point in time. So depending on what you accumulate, if you're in a high interest rate environment at that point in time, you will get a higher amount per month. And if you're in a very low interest rate, you'll get a lower payment per month. When you, yeah, well, yeah. So your annuity plan could mature you could set it to mature anywhere between 50 and 70, and you could change it, and you know, within that time. But when it matures and the payout starts, right? If the interest rate environment is high, you would find that you get a higher monthly payment, and if it's low, you get a lower monthly payment. It has, yes, it has an element of risk in terms of at that point in time. So let's say you set it for 60 and you don't really need the money at that point in time. You think the environment might change down the road. You might just continue having it. You could extend the maturity, continue having it, continue to contribute or not, depending, and just wait for the payout and hopefully, you know, thing. But you could get estimates of quotes as what you might be getting, you know, based on the, and see if it's worth it at that point in time. Yeah. Yeah. Okay. Yeah. Right. Yeah. So okay. So what the inch? Oh, okay. So the question is there a minimum interest rate that is paid on annuities when you in the contributory phase of it? Right. So annuities have two phases: the contributory phase when you put in money, or the accumulation phase, and then when it starts to pay out, it'll be the payout phase. Right. You could contribute all along the way and build up, and then go into the payout phase when it matures, or you could purchase an immediate annuity with a lump sum. So you could bring $2 million and say, I want to buy an annuity at age 60 and get a payout for life from that. So that's also possible. But the question that you're asking is during the contribution or accumulation phase, is there a minimum interest rate that is paid? Interest rate paid on the funds. That's what it is. Yeah. It was 4.5%. Yeah. Yeah. Okay. All right. Okay. Yeah. Okay. So okay. So what the contract has in it, right, is that so you putting in your money, you will get some kind of return, right? That return could vary over the life of the annuity. But there was a clause, a minimum guarantee clause, that set a minimum interest rate that would be paid, like in terms of returns. So on a number of plans pre-CLICO, pre the CLICO event, most of the insurance industry, that minimum was 4.5%. Right? Post CLICO, with central bank tightening up on everything, that minimum was moved to 1%. Right? So, and I'm not aware of it moving since then. Right? But you could read when you're dealing with the agent, you could ask specifically what is that minimum that is there. But most likely it's 1%. Yeah. If you have a very old policy, if you have a policy that you signed up prior to 2008, I guess, people would have been somewhere there, 2008, 2009. So prior to that, if you had a policy signed before that, you would have probably had 4.5% as a minimum. Might be a good idea. Might be a good idea. Well, it's a good idea for different reasons, because sometimes the extent of the commissions and the fees tend to be front loaded. So you may have already crossed that heavier fee period than not. So that's one reason you already get battered. So, so that might be one reason as well to keep it. And 4.5 might be very decent in this environment as well. So annuities, as I say, just be aware as to the nature of the arrangement you're getting into, the type of fees that are there, what is the exact arrangement. So for example, in the past, I think it's changed a bit now. If you, let's say we're doing $1,000 a month to your annuity, I think back then the commission fees, I think, could have been as much as 50% in the first year, 30% in the second year, 20% in the third year or thereabouts, and that kind of thing. So let's say you had that tiered structure, and you come and you introduce, or tell the agent, I want to do $1,500 a month now. When you make that increase, the $500 a month used to start over with the heavier fees, as if it's a new thing, right? So all of that, these things that were in play, I think some companies have done some amendments to those things, but it's good questions to clarify and to ask exactly how things are charged. But if it did an ad hoc payment, so instead of bringing the $500 a month, you decided to just bring extra $6,000 in one deposit, that would attract a lower level of fee. Right, so it's many different things inside the policies. Yeah. So just to round off before any other questions, I mean, just swinging back to budgeting, remember there's the whole element too of an emergency fund. You need to have an emergency fund set aside in a low risk investment or just in something very accessible to weather certain emergencies. Some people say 3 months of living expenses. Some people say 6 months of living expenses. But you will know your situation, especially in the American environment too, where you can say it could be let go same day. So you have to say, well, okay, how long would it take me to get another job reasonably, and have that money set aside as well, right? So it depends on your environment, the country, and your settings. You will decide how to swing it. So I think I covered almost everything I wanted to today. It was very engaging. Thank you for the time. Any more questions? Feel free to ask quickly. No questions online? Good? All right. Okay. All right. Thanks very much. Fantastic. Have a good night. All right.
Yeah, good night, everyone. Just want to thank Brendon. Um, Definitely, we know Sister Liz will give him that present that we promised him. But for real, a lot of information here. The session was recorded. It will be made available to the church. But definitely this information is invaluable. I hope that we recall, we take our notes, and we're in a position better to manage our finance and pass the information down. I think what we will do too is also make available some of the government programs that or agencies that help with managing the finance. I know he have a listing.
Yeah, not so much a listing, but the NFLP, right? The National Finance Literacy Program, right? Institutions, so like the church itself could, so like if you all want a follow-up session on a particular item that was discussed here, I'm pretty sure that you could reach out to them and somebody may, whether it's online or whatever, you could engage them to do a session, right? As well. A lot of the resources, if you go to their website, you would see a fair amount of resources too to help, in understanding, financial literacy, different same elements that I discussed there. They have something on everything, and even more instructive, just to get an idea as to they do a national financial literacy survey, and even the results of that is very instructive in terms of the status of of the country, right? But it's just to say that the group with the lowest level of financial literacy, I believe, is between 18 and 24, right? And that, when you overlay that with lower socioeconomic status, right, it's particularly low. So to me, it's a kind of a vicious cycle, right, where the literacy is low in the areas that you most need it. And it also points to a lack in our overall education system because, these are things that really should be introduced from school, come up, right, from early come up. But it's not there. I know some work is being done. I think the SEC is also doing some work on it, right? But it's still slow, and it's a dire situation. But it's slow work, right? This should really be in the schools, in the curriculum, being taught along the way, and even entrepreneurial mindsets. But um, how far this broadcasting? This is just this is within the church circle alone. Yeah. So the Financial Services Ombudsman and I had a conversation within the last 3 months. Right. I was in his office. We were having a nice chat overall. And, he was sharing with me some of the things because he heads up the financial literacy program as well. Right. And he was sharing with me, what he would really like to get done in terms of, that and entrepreneurial, and what he's been trying to do. He wants to solve. He was telling me that's one of the problems he was having. And then he was also having a problem in terms of how we wanted to track progress, right? And I told him, I said, well, you could solve one of them. I said, but you can't solve the next one. So he watched me. He said, well, why are you saying that? I said, well, you could solve the tracking because you could do a kind of, he wanted to do it very precise and scientific. I said, you could implement a proxy system and kind of do snap surveys all now because you have a lot of data from who you would have interacted with, and then do time series of surveys and kind of ask certain control questions, like in terms of, well, in the time, did you marry somebody who was into finance, so you could control for certain things that happen, right? So I say you could fix that. We can't fix the entrepreneurial thing. No way, no how, just so. I say because that come from in the schools. And schools tend to not only have it not in the curriculum, school in itself kills entrepreneurialism. The school system itself, right? It kills creativity, it kills risk taking, it, it teaches you that you have to work by yourself and working with other people is cheating, right? It teaches you a lot of other concepts that counter to things. So I was telling him that would be very difficult. And then he was saying, well, something about, like intergenerational. I said, well, yeah. I said, because that's what you think about it, that's what your parents told you to do, go and get a good job. I said, so I said, and they would have gotten that from school. I said, so it still flow back to the same thing overall. So we had a very good conversation on it. I think he appreciated the insight, but that's what it kind of is as well.
Right. So thank you very much. Definitely, we have some work to do with our young ones, especially at this time. I just want to close. I don't know if Brother Back could just close up in a word of prayer.
Blessing good night once again to each and everyone. Let's go to God in prayer this time. Our Father who art in heaven, hallowed be thy name. Father, as we approach thy throne, we humble ourselves this night. We thank you for your love, we thank you for your mercy, and we thank you for your only begotten Son. Through him, we may have life and have life more abundant. We thank you this night, dear God, and we thank you for Brother Brendon, Howell, their father, who have we continue to be with him and his family, dear God, Sister Liz and others, dear Father. But we thank you, dear Father, for the topic and planning and budgeting, dear Father, for the future, dear Father, and more so, dear Father, that the goals and what we expect to achieve from retirement and all these other aspects when financially wise, dear Father. We pray, God, that we will take this information, dear Father, and put it to good use and even to pass it on to others. We do pray, dear Father, for those who are online, that they were able to join with us too, dear Father. And as we meet and collaborate, it will help us, dear Father, for those who are retired, for those who continue to plan for the future, for the children and for generation. We know financial is very important, and we have to take good use of it, dear Father. We thank you that you continue to provide for us food, clothing, and shelter. We thank you, O God, that you continue to be our master, our creator, and we thank you for all that you have continued to do with us. Even at this time, dear Lord, as we seek to make our way home, we pray, dear Father, that you take us safely to the next appointed time. We can come and praise and worship you, dear Father. But we thank you for once again Brendon and his family, and we thank you as you continue to be with him and in all his endeavors. Thanking thee for everything else at this time. Watch, guide, and protect us. Continue to keep us in your love and care. This is our prayer, for it is in Christ Jesus we pray thanksgiving. Amen and amen.
All right. Good night, everyone. Take care. Enjoy.